Good morning, good afternoon, and good evening, depending where you are on the planet. And welcome to today's Bull versus Bear webinar. Here, Steve Miley on the call for trade day on Wednesday, the 19th of April, 2023. Welcome, everyone. Welcome. So we're going to go through usual regular run through here today. Not too much to really say in here at the moment, but there are some things going on in Europe I think are more interesting, inflation-wise, particularly UK. We'll take a look at that, see what's happening in markets, and see what we've got coming up as usual. Major news wires. Take a look at the Fed tool. Take a look at some of the charts. See what's going on. So, little look back to yesterday. So S&P was only up slightly on the day. Broadly, US indices only slightly higher in the day. Let's go and jump to that. So here you go. So look, S&P was up less than a tenth. Dow was actually down, but negligible. Nasdaq, I think, was slightly minimally up. I think just very, very eked out. Less than a tenth again, though. This morning, though, look noticeably lower, basically between 0.5 and 0.6% lower in here today, and getting dragged down in here by concerns, I think, from two factors. Basically, it's all being driven by higher yields, and those higher yields partly that's the way we've been going. I've been flagging this for some days now, how resilient the stocks have been as we push to higher yields in the US. But I think, a combination of the higher yields in the US, a combination of the inflation data we've had out of Europe, which I'm going to touch on as we go forward, and a combination of what was the other thing? Yields. Oh yeah, and then the yields, echoing kind of a slight shift in that Fed tool, a slight shift in expectations of what we're going to get from the Fed, and also a little bit more information from the Fed. So let's take a look at all of that. So we did only just eke out gains. Johnson, it says Johnson and Johnson. I didn't look at drill into the numbers, but it says in here disappointing. Goldman in here, certainly the numbers weren't great in here. So and so this is just looking back to yesterday, but futures lower in here this morning as well as treasury yields rise. Also Tesla tugging lower. Now we do get Tesla later today, the earnings, okay, but Tesla announced further price cuts in here for its Model Y and Model 3. In here, it's lowered prices 6 times this year in the US. So that's kind of weighing on Tesla in here a bit. So all of these little things are adding up. UK, EU inflation data, higher yields in the US, Tesla in here, some comments from the Fed, the yield curve as well, the short end of the yield curve as we look at the Fed watch tool weighing on markets this morning. Let's look at the data. Well, the data's fairly quiet going forward. We do get the Cushing crude oil inventories at 10:30 today. We get that every single week. So if you're an oil trader, it's interesting maybe. If you're not an oil trader, it's probably not too interesting. We get ECB and BO, Bank of England speakers later today. The main focus really for me is going to be much later this evening, 7 o'clock US Eastern time today. We get Fed member Williams speaking. So we're watching out for that certainly later today. Looking back, though, the main data this morning was this CPI data from the UK. So even though it dropped from last time, so the year on year is like the real big headline data, 10.4 previous. The expectation, though, was to go below 10%, came in at 9. Expectation at 9.8, came in at 10.1. UK's got the highest inflation rates in Europe. I'm pretty much sure the highest inflation rates in the major global economies. Okay, so that's not really helping matters. And what it's seen is initially saw the pound go higher. It saw bond markets sell off aggressively in the UK, pushing to higher yields. The expectation now for the Bank of England to continue to be hawkish. We're looking for 2 more interest rate hikes from the Bank of England at the next 2 meetings, and potentially another interest rate hike further out in the year. You contrast that to what the Fed are doing, maybe 1 more hike, and then the market's actually expecting rate cuts. Well, we're looking for 3 more potential hikes in the UK, taking us to a terminal position of 5%. Now, I know that's where the US is going to, but there's been a steadier path up. The UK actually, I think, started hiking rates, I think, just before the Fed. I think the UK were one of the first to start hiking. I recollect we actually hiked rates in the UK at the end of not last year, the year before. And I think the Fed kicked off. I think liftoff and rates was the very beginning of last year. Maybe it was the beginning. Maybe it was the end of 2021. But I think the UK actually hiked first amongst the world's major economies. So so not good in here from the UK. It's been the case. We've been hot inflation the whole time in the UK, it's been a bigger peak, and it's not really coming down as aggressively as we're seeing in other nations. We also got EU, Eurozone as a whole CPI that came in bang in line with expectations, as you can see in here. So just in black, meaning in line. So EU in line with expectations. UK though much worse, and that's not helped matters in here this morning. That's not helped European stocks. It's not helped the US stocks in turn in here as well. So let me just jump through from this to some of those articles. So UK inflation, traders now betting on 5% BOE peak rates. The reason I'm covering this, guys, is really important. I think it is having a knock-on effect into the US because there has been a shift in focus, I think, a little bit onto this higher yield move. I've been flagging it for days now. We've been pushing higher in yields in the US. Let's go and take a look at that yield chart. The US 10-year, I've been flagging this. We've been nudging. Look, it's been a significant move high. In like a week, we've jumped from sub 3.5 to now 3.65%, right? So it's a significant move. And, only back here, we're at 3.25. Now we're like 360. Okay, so we're at 3.25 at the beginning of April. And now we're at 360. Okay, we also took out this little yield peak in here this morning. Okay, we took out that yield peak. That's from the very end of March, pushing towards this peak in here from the latter part of March, nearly the highest we've been since here. Pretty much we've been this morning since the middle of March. So that's like a 1 month high in yields. Okay, so that is a little bit concerning. Let's have a look where we were in stocks when we were back at this yield level. 15th of March in here. Where were we in stocks? Let's have a look on the S&P on the 15th of March. Where were stocks? Well, we were all the way down here. Okay, so the S&P was somewhere between 3,900, 3,950, and the NASDAQ, 15th of March. Last time we were at these levels, we were down here at like 1,200 to 12,200, something like that. Okay, so we're significantly further away in considering where we are in yield, and the fact that we continue to break higher in yields, the fact that you've got this also inflationary data coming out, as I say, from the UK. Okay, and then the EU data was bang in line with expectations, so that's not great. You'd like to have seen it maybe beating expectations. So all of this is pushing the anticipation of the global yields higher in here. And if we look at the Fed tool, I'm jumping around a little bit in here, but if we look at the Fed tool, so this was still stuck up here. This is for the next meeting. We're pretty much nailed on for a 25 basis point hike. And incidentally, if I go to this oil report in here, so the oil report mentions the fact that we had Bostic. So Bostic Tuesday. So look, the US Treasury is likely having one more interest rate in store. Atlanta Fed, Raphael Bostic said. And the 86% chance of the Fed raising, we know that already. So we're kind of getting affirmation that we're going at least one higher. We kind of know that already. But just look at this Fed tool in here where we were in here. So we know we were on hold in June and July. That's been that point for some time in here. But more certainty now on hold. But now look, September. We were looking at only yesterday. This was priced in for a rate cut. This was just higher than this. Now we're priced in for still unchanged by September. And now we're looking at the rate cut. So it's pushing out where the rate cut's coming. Now the rate cut in November and then another one in December, okay, is what the market is pricing in. So we're actually 25 down from where we are now. So looking for, by the end of the year, 25 up and then 225s back down again in here. So this is pushing out. We're pushing out that in time. That's certainly happened. And if I go and take a look at maybe that the chances of this 454.75 at year end, let me have a look at that on the historical. So for the year end at 454.75, let's get rid of all of these. And what we'll see in here, oh, there it is there. Now this is actually showing it's creeping up. Oh no, just a little rollover in here. But actually, let me switch it to the September. And I'm going to have to take them all off again in here. What's the chances of us being lower in September than we are now, which is there? Look at this. This is the interesting one, right? So basically, we've risen and we've been sitting up here as a very good chance of a rate cut in September. Now we're seeing diminishing chances of a rate cut in September. Okay, so it's pushing it further out down the curve. This is the worry in here. This pushing further out down the curve, it kind of goes hand in hand with yields going higher, the longer term yields going higher. Okay, it's the same kind of, the short end is going is we're seeing the short end slightly steepen, and then also then seeing the back end pushing to still higher yields. So yeah, that's what's driving this alongside what we're seeing in UK EU. Question from Clinton. Hi Steve. Do you see the UK and EU CPI plus pushing the rate cut out? So something that will likely continue this overnight pullback into a multi-day pullback. Good question. I mean, I think it's the price action, and I'm not going to try and evade the question, but it's going to be on the price action, because at the moment, if we go and take a look at where we are, it does look wobbly, right? If you go and take a look at let's look at. I'll come to the chart in a minute, but we'll address that. For me, it's we're basically seeing higher inflationary pressures out of Europe. Higher, a more hawkish tone potentially from the UK. And we've seen anyway, the US has been pushing to the higher yields. Bang, there's the chart there telling you that. We've now gone to a new multi-week high in yields. So all of this is adding to pressures. Bostic, who's more of a dove, if we go and take a look at the Hawk Dove sheet in here on I use this one on In Touch Capital Markets. But if we look at the Hawk Dove sheet in here, where are we? Bostic sits up here, more of a dove. He's staying. He's not particularly getting any more dovish. Still looking for one more rate hike in here. And so all of that is adding up to higher yield pressures weighing slightly or less, as you say, pushing out the rate cut from the market. Well, the Fed have already told us, Clinton, right? And for the rest of you, the Fed's already said we're not cutting rates. Literally that is what he said. We don't see. That's what he actually said. What Powell said about 2-3 weeks ago. Oh, we just don't see them. We just don't see rate cuts. Yeah, but the market's still expecting it. So yeah, I think it is pushing back. Whether I'll come to it in a minute, Clinton. Okay, because I think it's all about the price action. I'm a technical analyst at heart. I think it's whether it breaks the levels, and we'll come to those in a minute. Let's just run through the rest of this in here, though. What else do I have? 5 things is kind of dull in here. Layoffs from Meta, that's not helping in here. Fox Dominion boring. Risky bonds, this is just saying that the AT1 bonds, those 8 additional tier 1 bonds, actually there was an AT1 bond sale in Japan that went pretty well, so that's as good. That's seen as a good recovery for that bond market, for the fact that we got that bond sale go through in here. Remember, only 3 or 4 weeks ago we were felt like we're going into another financial crisis. So the fact that these riskier bonds, this bond sale went well, that's definitely a positive. Not much more in there. 5 things to start your day, but it's all about, look, so traders bet on 5% peak of inflation. UK inflation highest in Western Europe, falls only a little in March. And again, look, morning bid sterling's inflation set. So the pound went higher initially, but pound's up against other currencies, euro, Australian dollar, etc. But the dollar is strengthened this morning because we've seen dollar go up as a safe haven. So dollar up as safe haven because stocks are obviously dipping in here. And also dollar going up because of US yields are going up as well. And oil in here sliding lower alongside the stock indices. European shares retreating, earnings season, and then inflation as well. So all of this adding to the mix. That's pretty much what I've got. I've already looked in here at the macro calendar. Really not too much coming up. Williams later. Micro calendar, the earnings calendar more important. ASML kind of mixed bag in here. Slight beat, actually a decent beat on EPS. Only a very slight miss on their revenue, and then Morgan Stanley in here, just a slight miss on the EPS and a decent beat on the revenue in here. So this is still looking relatively healthy on the earnings side. IBM after the bell, but the big one after the bell, $500 billion company. Tesla is an automaker, right? But also seen as like consumer discretionary product. So we'll certainly be keeping an eye on that as we go into today. We did get Netflix last night, by the way. Netflix kind of mixed and didn't really tell us anything more about the global or US consumer. Let's take a look at the charts now. I think, we looked at the Fed tool. So for me in here, Clinton, it is about the reaction now. So we've obviously had this dip lower. So yesterday you could argue long-legged doji at the top, okay, having made a new high. Remember we spoke about pushing into this topping area that we posted in here, back in February, the first half of February. We've got a multi-point top in here. It's like a 5-peak top. And we looked at that yesterday. If we zoom out, you can see this 5-peak top up here. Okay, so the market pushed up into that and then fouled just below this little peak in here. Remember, we flagged that peak up there as resistance, fouled back from there. And then I think this is what's important now. I'm going to just change this to maybe like a 15-minute chart. So the market is like, setting up in here for this to be a potential. Let me get rid of all the drawing tools here. In here, I think the critical in here is we're down through this kind of more accelerated trend line. This is what I would be looking at here. So this one we're not down through. And this is on the S&P, which has definitely been taking the leadership in here more recently with the kind of underperformance, the natural underperformance because of the higher yield moves. And if we look at this more accelerated trend line, say through here, whether you put it through here, that's probably the best one. Okay, so the market's kind of flirted with that, or whether you would redraw it and you'd pull it out to here. Whoops, I'm going to leave that one in. Or whether you redraw it, whichever way you draw it, right? It doesn't really matter because we're through it anyway, right? So you've got this potential top. I think critical now, look, now you've got lower low, lower high, lower low, okay? But we've only broken arguably one low in here, this swing low in here, to make this low. Okay, that point there for me is critical. This looks more critical, but I think this one's critical and we're holding above it. So that would tell me this one and certainly that one. But if we take this one out, we're probably down into shifting to more of a bearish tone for the next couple of days. Okay, so that one there, 41.48. I mean, if it takes out this one, then it certainly looks more negative, 41.38. So 48 and 38 key levels in here for me now on the downside. But the market is trying to rebound. I'd hang on to a bullishness whilst we're above because the market is pretty resilient. And then you'd be looking at either this counter trend line right off the top, okay, through here, or this kind of internalized one that runs more shallow across there, okay? But anywhere what you'd see these back above, I mean, if you want to be aggressive, it's back above like 41.65. Less aggressive is back above like 41.69 if you want to wait a little bit. Back above there, though, this all starts turning again. So I think, those are the key points. 65.69 on the upside, down through 48 on the downside. Looks more vulnerable. And similar story, I'm not going to do all the analysis, but on the NASDAQ in here, it's holding that low there. So we've already just dipped and pipped at that low. It's that low there. So if we go in here on the 15-minute, we have taken out so that's the key low that I said there. Look, but we've just literally flushed below it and come back. And it seems to be respecting this one more. So now that one's going to be our big line in the sand. So I think more activity below this low here, which was, where am I? 0670, sorry, 13.07.675. We just did pip below there. So 067675, this low is 65.065. So down through there would be, I think, a concern, or, if it starts to break that one there, here it becomes more of a concern. So 75.65 area, certainly down through there, it looks very vulnerable. That's 58, 13.058. But then again, top side, look, we're trying to get a rebound going in here. You've got the more accelerated line right off the top, down through there. Okay, so we're not far off, breaking back above that. That's going to come in somewhere around 13.120. Then you got this kind of more cautious internal line that runs across like here. And then that helps us through these little failure peaks in here. I think these are important because they kind of tie up with this low, these lows here, these two lows here, and these peaks here. So that is and then the trend line's just above. So that zone there is 13.140 up to 55, 13.140 up to kind of 55. That would be another. If it gets up through there, then I think we could be all the way back up here again. So it's a little tricky one, I think. What is your opinion with regard to trading the Russell 2000? You know what? I don't really look at it. I'll be really frank with you, Jim. I don't really look at it. I haven't covered that since, back in the day. I used to look at that when I was at Credit Suisse, and we used to look at it a lot more when I was at Merrill Lynch. Now we're talking over 10 years ago. It's not something I've traded. I've not traded it personally. I don't really look at it. I'd be kind of making it up if I gave you an answer. My recollections from back in the day. Let me just stick it in. Why not? Let's have a little quick look for you. But my recollections, okay, is it kind of performed a bit like the RTMY3, right? It performed a little bit like the Nasdaq, right? If I'm not mistaken, right? As obviously it's following the others anyway, right? But my recollection is it's kind of a higher beta version of the, not quite as high beta as the Nasdaq, but a higher beta version of the S&P. And you can see it's pretty much done the same thing. It's kind of taken out this low in here, but it's holding this low over here. Okay, so yeah, I mean that's going to be the short term support there. Yeah, so that low 1793. I mean, obviously the critical one more like over here, down all the way down here, but that's a long ways off. Yeah, 1793 is the line in the sand, and then I do the same analysis. Yeah, I've got nothing against trading that. It just sits, I think, somewhere between trading the S&P and the Nasdaq. Right, that is my recollection. But having not looked at the price action for some time, is that your experience, Jim? I don't see why you can't trade it. As long as the liquidity is there on the mini, which I assume it is. Has a liquidity for you? If you get a chance, pop it in. But yeah, so generally in here we're seeing markets kind of have reacted to that. The high yield pressures coming out of Europe, high yield pressures they've been coming out of the US anyway. So you do need to keep an eye on that bond chart, I would say. So just going to the 10-year in here. So look, if it takes out this low over here, I'd be kind of really worried. Okay, so I think that's the line in the sand now on the futures. If you want to put something on your futures chart, if you want to put an alert, that's your experience, Jim. Yep, thank you. So 113.26. If it takes out that low, the US 10-year, right, I'd watch out for that. Yeah. Does CPI from non-US countries count as tier one data? No, it doesn't, Chris. So basically, the only tier one data is the tier one data that you see. So if I go back to here, so it is in our. It's going to be in the. It's not in here, right? It's in the on the main site. So it's just what you see in here, right? It's just literally those. That's all you've got to remember, okay? We try and keep it. I mean, we're trying to keep it as simple as possible, but we've got too many people, right, who are either on the evaluation just punting and gambling. We don't want gamblers, right? We've had too many people go through the challenge, pass the challenge, and go and try and trade tier one data and just blow the accounts literally in seconds, okay? And we're not here to gamble, right? This is not the business we're in, okay? And it's our money, it's real money. And people complain about it, but you know what? Other, proper prop firms don't allow it to happen, so why should we? Okay, but if you go and look at the tier one data in here in the article, here, where is it? Economic releases, can I trade news? And you'll see is literally these things, right? Is literally that is it, okay, for the US, okay? CPI, maybe I'll get that amended to say US, okay? It's US CPI, US non-farm payroll, okay? So FOMC, minutes and statement, CPI, US CPI, US employment report, and then if you're trading oil, obviously, only if you're trading oil, the crude and natural gas data, and if you're trading the ags, the crop production reports. That's it. We'll try and be as lenient as possible. Might be adding to those. Don't think we're going to be taking away from those. All right, guys. I'm going to wrap it up there. Any further questions? Good bit of interaction today. I like it. You kicked it off nicely, Chris. Thank you for Jim. Sorry, Clinton started us off. Thank you, Jim. Thank you, Chris. Like a bit of interaction. All good. Any questions? Anything else? No. Right. I'm going to wrap us up there. Have a great trading day, everyone. Take care. Stay safe. I'll be back. Actually, I won't be back. It may be James. Keep an eye out on the calendar. On the forum. Okay. We may not be. I don't think it's going to be a webinar tomorrow. Okay. Tomorrow, probably no webinar. Keep an eye on the forum. Keep an eye on the heads up, the scrolling heads up that you get in the members area. We'll put a post up there. I'll certainly be back on Friday. James may or may not be covering tomorrow. I think we're probably going to be no webinar tomorrow. But keep an eye on the forums. It'll be in the forums and in the heads up that scrolls across the top of the trading room. All right, guys, have a good one. Take care. Stay safe. Bye.